So the title of the webcast in general is Global Reboot, the Changing Structure of the World Economy. I have quite a bit of ground to cover in the next 30 minutes, but just to set the framework, the structural shifts that we see happening, I'm going to go through at the beginning of the webcast, and then I'm going to go through some of the cyclical drivers that are currently in play, and then look at what's happening in markets before turning it over to Mark. On the structural side, I was going to cover three main items: China, Russia, and inflation. So let's start with China. As you can see the title here, we think that going forward, China is going to face increasing headwinds to their growth, which is taking them kind of off that one of the leadership roles of underwriting global growth going forward. So let's start a decade ago. We can see that in 2010, China was only about 10% of the global GDP pie. But given the rapid expansion that China has experienced at the end of 2021, they were actually larger than the Eurozone and pretty comparable to the United States as a share of global GDP at 18%. So what are some of the headwinds that they're going to face? One of the things that we've been talking about over and over again in these webcasts has been COVID. And I think, COVID appears to, be no longer a first order factor for most countries outside of China. And the reason for that is what's being reflected on this chart. These are the COVID confirmed deaths over time, and it's broken out by different regions. And what we can see is that overall the death rate has come down, and that's due to increased vaccination and herd immunity. But in China's case, what we saw was a very effective policy of locking the country down called zero COVID, as I'm sure we're all familiar with, where China really did lock everybody down, not allow people to move, that prevented spread. Unfortunately, the two things that have helped the global death rate go down, vaccination and herd immunity, were not able to fully propagate through the Chinese population. So China still remains vulnerable to COVID spikes, and we're actually seeing a tick up in COVID cases right now. We think that until China gets procures a better vaccine, whether it's through a new mRNA technology from the West, like the BioNTech potentially, or they develop one domestically, it's unlikely that we'll see a big move away from zero COVID. The market got excited over this weekend, actually, that China might be making a big announcement. But as many of us saw, China is still not ready to move away from zero COVID because of the reasons that I just highlighted. So in the past, China has really depended on credit growth and the credit impulse, to spur growth, especially, when in times of economic downturn. Credit has been a strong counter-cyclical factor, meaning when growth slows, they pick credit up. So what we see here is a 12-month change of what we would call the credit impulse, or the change in credit to GDP. And usually when China's credit impulse picks up, we tend to see growth pick up. And what we can see on this chart is China's PMI. So you can see in the 2016-2017 period, PMIs picked up from below 50 to above 50. And in the prior chart, we saw that was, the second to last prior pickup in the credit impulse. And then post the 2020 pandemic, credit picked up, and so did the PMIs in China. This time around, China PMIs are remaining challenged. And it does not look like the credit impulse is going to have the same impact that it had going forward. One potential reason of this is the zero COVID lockdown. And we can see that, this is a nice measure of the potential GDP that was lost, or the path of the way Chinese growth has materialized post-COVID. And we can see that, as per the path that it was on prior to COVID, China has actually lost, according to this estimate, about 1.5 trillion of potential GDP since the onset of COVID. But we don't think zero COVID is the only reason for the loss of this GDP. We think increased regulation, which picked up, in the past several years in the property sector and technology is also responsible for some of this loss. But we also think the very high debt load that China has incurred from these credit stimulative policies are finally coming to the forefront to, act more as a economic headwind rather than an economic tailwind. And I think that's most obvious in the property sector, which is now bleeding into the Chinese banking sector. Well, we can see, as we know, China has been facing, increased pressures on their property sector. We see here that the rising number of Chinese developers are facing decreased earnings and negative equities. That has led to rising NPLs. That has led to more defaults on, in the Chinese system, and that's starting to hit the banking sector as well and the provision of credit. So we think that, the debt overhang that exists in China is going to stay with them for some time. It's going to take some time to work out and is going to act as a headwind to Chinese growth going forward. Another issue that I think we should all have on our radars is, the new composition of Chinese leadership. So we just finished the 20th Communist Party Congress, a couple of weeks ago, and we effectively saw Xi Jinping, be appointed or be, confirmed as, to his third term, but effectively he's going to be leader for, the rest of his years is kind of the going assumption right now. And the question was, what would that leadership, look like that he would put around him? Would he put technocrats around him that were focused on market reforms and understood that, tough decisions needed to be made? Or would he put people who were a little bit more focused on politics around him? And unfortunately, Xi has consolidated power by putting loyalists or people who tend to be more aligned with him in all of the key standing committee positions over some of the more technocratic names that were on the list. Now, some people say that this should help policy implementation going forward. I tend to think the opposite. I tend to think that what you want to see in these positions is people very focused on the job who will tell you the truth and tell you what you need to know, no matter whether it's a message you want to hear or not. And the risk of putting political appointees in these positions is you don't get that message and there'll be policy drift going forward. So because of this new composition of policy, I think that is also going to be a long-term headwind to Chinese growth in the coming years. Also, Chinese growth has really been underpinned by its ability to export to the globe. They initially started as exporting cheap labor, and they became an integral part of the global goods supply chain that got accelerated in the 2020 COVID pandemic. But now that's starting to come down, and we're seeing that start to fade. We're seeing slowing goods demand as global growth is starting to slow, but more importantly, we're starting to see other, other concerns, nations that import from China come to the forefront. Most specifically, national security concerns, as countries become more skeptical of China's long-term intentions and long-term goals. They're looking to, and after seeing the vulnerability that most countries had to imports from China during the COVID pandemic, we're seeing a lot of re-onshoring or friendshoring by bringing production either back to their home country or to countries much closer by or to friendlier nations in order to prevent any future issues that happened when China decided to hoard PP&E during COVID. And then finally, China faces a lot of geopolitical headwinds. We have talked about Taiwan a lot. Taiwan continues to remain an issue. Our base case is that China is probably not going to immediately initiate any type of a kinetic war to try to get Taiwan back. They will just continue with this slow pressure to try to re-assimilate Taiwan into China itself. But Taiwan does remain a risk. The South China Sea, as we know, also remains a risk as there's freedom of navigation exercises that are happening, as well as the militarization of many islands. So, that remains a risk going forward as well. We talked about the re-onshoring due to national security concerns of many nations, but that has the potential to, escalate into potentially more of a geopolitical problem. And then one item that I don't have on here is China's increasing alignment with Russia, and Russia being facing increased international scrutiny due to their invasion of Ukraine. All of these geopolitical risks run the risk of heating up and becoming an even larger impact to Chinese growth. And as we showed, because China is about 20% of the global GDP pie, going forward, looking at China to underwrite global growth going forward, I think is going to be structurally different this time around. The second pillar that we were looking at for the structural change was what happened following Russia's invasion of Ukraine. We don't see a quick end to this war. It looks like both sides are digging in, which I'll get to in a second. But the takeaway is that Russia is being systematically removed from commodities markets and financial markets, and that is going to have a lasting implication on global growth and inflation. So let's get into it. There's a lot of detail on this slide. If you would like to request the slides to read through, I have some more detailed slides. Please, request slides either through this webcast or at fundinfo@doubleline.com. But basically, the war started in February 24th. And then most recently, I think there's been a lot of excitement about Ukraine's potentially gaining some ground back that had been initially taken by Russia. But Russia has responded very aggressively by Putin basically enlisting a draft on September 21st. And then we're seeing increased military activity across Ukraine by Russia. These, all of these events lead us to believe that there is not going to be an immediate end to this conflict anytime soon. So what is, the first order repercussions of Russia's invasion of Ukraine? Well, they're on the energy side and on the financial side. On the energy side, we're seeing energy sanctions that are effectively removing Russian energy and Russian commodities from the global commodities markets. And we're going to get into in the next couple of slides why that's very important. On the financial side, we are similarly seeing the removal of Russian financial assets and the Russian banking system from the global economy that is also having important impacts going forward. So to focus first on the commodity side, we can see here what we see here is a chart of Russia's percentage of global commodity production by different sectors. And we see energy, metals and mining, precious metals, and agriculture and fertilizers, across the bottom. But what you see is that Russia is a very large player across all four major commodity sectors, in some cases, being above a quarter of global production. So this is, the removal via sanctions of Russia from these markets is going to have a lasting impact in our markets and needs to be thought through country by country. We can see that on this chart, the biggest impact is going to be felt in the Euro area and also in the Central and Eastern European countries, which is seen on the left-hand side of the chart with, the percentage of global GDP that Russia and Ukraine, are exporting to these areas, and those are the highest areas: the Euro area and CEMEA. So it is this systemically important exporter of commodities, to these regions. So let's take a look at what's happening on the energy side. As we know, energy is being cut by Russia to Europe. We know Nord Stream 1 is offline. We know Belarus is offline, and it looks like there is no end in sight to the reduced energy going forward. That obviously is going to have lasting impacts not only on the price of energy, which is pushing European inflation, very high, but also on, European growth. And more specifically, German growth, where Germany had relied on cheap energy sourced, a lot from Russia in order to, run its industrial machine. So going forward, energy is going to have an impact both on inflation and growth for Europe. Well, now let's take a look at the flip side. Where is Russian energy going? Did they just keep it all domestically? The answer is no. what we can see on this chart is the falling share of Russian oil exports to Europe in the red bars on the chart on the left. And who made up for it? It is India and China increasing their imports from Russia over this time, which brings us back to one of the first points, a point made in an earlier slide, the rising geopolitical risk that comes with China and India realigning themselves more closely with Russia going forward. So it's not just energy that remains a risk. Both Ukraine and Russia remain very large players in the agricultural commodities markets as well, especially food. So when we look at corn, wheat, rye, these are all essential foodstuffs that are basically being completely taken offline. Either in Ukraine's case by the war, or in Russia's case, by sanctions, both direct sanctions and via the banking sector. This is potentially going to lead to food instability risks on top of inflation risks going forward. And then one other item that we just wanted to point out is going forward with the new planting seasons, outside of just the regional issues that are associated with taking Russia and Ukraine offline. Russia and Belarus, I should say, remain some of the largest exporters of potash, which is a key ingredient for fertilizer. So going forward, crop yields across the globe will be impacted as fertilizers become more expensive and less available. So what are the impacts of all of this? Basically higher commodity prices and higher inflation, the potential for commodity shortages, not only in energy, but also in food. So food insecurity, increased geopolitical risks, as we know, slower growth across the Eurozone, and, the potential for more deglobalization and friendshoring. The third structural shift that I wanted to go through is inflation, which we are all aware of. Here we can see the impact from a lot of these changes, especially via what happened in Russia, but also due to underinvestment in the energy sector. What we see here is inflation broken out by year, by region, and this is an IMF chart. And it actually splits out the reason for the increase in inflation each year. So we can see that the red bars stand for the increase in inflation due to food. The blue bars stand for increase in inflation due to energy and transportation, which is basically energy, and then other is yellow. And we can just see the large impacts in Europe especially, but across the globe, really first being driven by food and energy, which is a headline component. But we will get into this in a minute. We're starting to see now second round impacts into other areas of the economy and pricing as well, which is becoming more concerning. Here, we're just showing that it's not only an emerging market problem that is, that inflation is not only an emerging market problem this time, but it's also a developed market problem, as we see the dramatic increase in food prices across several of the major developed market economies. And then the one thing about this inflation cycle this time around is it's caught many people by surprise. And we can just see that in the estimates by the IMF, we continue to get revisions up every World Economic Update, or every chance that the IMF gets to update their forecasts, they're having to update inflation higher and higher. Now, this is important because it has caught a lot of forecasters by surprise how high inflation has actually gotten this time around. Well, going forward, the path of inflation, as far as these same forecasters, is projected to fall, very aggressively, over the next year to 2 years, as seen by the dotted lines for the Eurozone and the United States, in this chart. But Deutsche Bank, who I'll give credit to for this chart, has gone and looked through history and said, what has happened when inflation has breached 8%? And since 1970, we can see that of those instances, inflation has tended to be more sticky. So unfortunately, history is not on the side of the forecasters, this time around. So we're going to watch that very closely, to see how aggressive the deflationary path can be. So again, here we're just seeing headline inflation pick up across the major developed market economies. And potentially in the US, we're starting to see some stabilization on the headline side. But in Europe, especially UK and the Eurozone, we're already into double digits. But more concerning, or just as concerning, something that we need to pay very close attention to is the measure of underlying inflation, or core inflation. These measures were expected to remain much more well contained, as initially these inflation spikes were thought to be one-off, supply chain or commodity driven. Unfortunately, the core inflation measures no longer are well contained, pushing much higher across the US, the Eurozone, the UK. And I think the path of underlying inflation needs to be monitored very closely. One reason that we're, an additional reason why we're starting to see core inflation measures pick up as well is that labor markets remain tight. And I found this to be, a really nice chart that kind of shows just graphically what's happening in labor markets. And what we're showing in this chart is the number of job openings in the U.S. relative to unemployed people. And we can see that you basically have 2 jobs for every 1 unemployed person, which is the highest it's been, over the past 2 decades, basically. So until this starts to normalize, until we either get more people back into the labor force looking for jobs, or some of these job openings start to go away, price pressures, especially on the wage side, will remain high, keeping core inflation high. So looking globally, I think one of the key questions is, when do we see the shift in inflation coming? Potentially it's coming now due to cyclical factors, which I will get to in a moment, which would help on the headline side. So, without further ado, let's just quickly move on to the policy credibility. So, what do we do in the face of all of these structural headwinds? And at DoubleLine, what we have found, especially on the emerging market side, is it's policy that addresses inflation that is most important. And we look country by country to decide whether we think there's appropriate policy to deal with the both price impacts and growth impacts, of what's happening in the economies. So let's just take a quick look. I've aggregated across region, policy, what I think are good measures of aggregate policy to kind of make some points. Let's start with the central banks. What we're seeing here on the first chart on the left is the average central bank policy rate minus the current rate of inflation. And what we can see is that really the only region that has gotten in front of inflation or raised policy enough to actually be above the rate of inflation on average has been Latin America. And, Asia has done fairly well. And actually, it's been the advanced economies in Europe that have been lagging behind. So has Latin America done this because inflation hasn't been as aggressive? The answer is no. If you look to the chart on the right-hand side, you can see that actually Latin American central banks have hiked on average cumulatively in this cycle more than any other region as well. Now, keep Latin America in your mind because we're going to come back to it, in a minute. This chart just goes into detail on all the central banks and their current actions in this hiking cycle. Again, if you'd like to see more, please request these slides. The other piece of policy credibility that I just wanted to touch on briefly was looking at fiscal, the fiscal authorities. And what we're looking at here is the change in the fiscal balance from prior to COVID 2019 to the end of 2021, and the rise in the debt rate. And what we can see is that on the chart on the left, the emerging markets actually had less of a fiscal deficit widening relative to advanced economies, which stick out like a sore thumb this time around. And that they also had, on a percentage of GDP basis, less debt growth relative to advanced economies this time around. And we just added the detail of all of the countries on the fiscal and debt side. Just for those interested, you can request the slides. Now, why is this important? The UK recently went through a bout of, the market, I think bond vigilantes and, currency vigilantes came back. And they've told the developed markets that no longer do you sit in a position of privilege. No longer can you get away with debt monetized, fiscal spending. And so let's take a look at the UK very quickly as a canary in the coal mine for what is happening across developed markets. The UK has seen a spike in inflation, yes, due to energy prices, but also they have, I think the fiscal spending, the monetized fiscal spending, has pushed inflation, a lot higher across developed markets than it has been in the past. And what happened is the UK brought in a new government. Prior to Rishi Sunak, Liz Truss came in and she put forward a budget that was going to be a very large debt finance fiscal stimulus to try to deal with the rising energy prices, and the markets pushed back. What we see here in red is a falling currency, and in blue, a spiking interest rate. So both the currency and the bond markets pushed back very aggressively, in the UK, saying that they would not accept, another debt financed fiscal stimulus. And it actually forced that Liz Truss out as PM. And now we see a former finance minister in Rishi Sunak coming in to try to address the problem. So we'll see if the UK can get itself back on track. But this stands as a warning to developed markets that the days that they thought they could get away with debt financed fiscal stimulus may be coming to an end. And we as investors need to pay attention going forward, because I think the policy credibility is going to be a key factor for global markets going forward. So cyclically, what's happening right now? Obviously, we know central banks are increasing interest rates to deal with inflation, but what they're also doing is they're draining liquidity. And I think this is a key point to focus on. What we're seeing on the liquidity drain side is they're reducing their balance sheets. We see reserve managers intervening in FX markets, reducing US dollars in the global market. And then this is actually an excellent chart by David Rosenberg, who points out, using M2 as a measure of global liquidity growth, global liquidity tends to lead, the global growth. And what we see here is his calculation of global M2 versus the US manufacturing PMI. And it shows that M2 tends to lead PMIs going forward, and M2, or liquidity, is in contraction right now, which means that global growth is going to continue to face headwinds going forward. And this is further confirmed by the JP Morgan global PMIs. Both manufacturing and services have dipped into contractionary territory. So ultimately, the real question is, how much is the tightening policy going to impact global growth going forward? We can see there has been, on the chart on the right, revisions down in global GDP forecasts, in some cases into recessionary territory. So the question is, how bad is that going to be going forward? And in the interest of time, let me just quickly jump to the markets. What we're seeing across global markets, not just in the US, but everywhere, is rising yields across the curves, both in the front end and the back end. And the key where we are today is, when will central banks be allowed to pivot? What we're looking at across Europe, across the UK, and even in the United States, is that the implied hiking path for central banks continues to be revised higher, and that terminal rate continues to be moved up as inflation pressures remain sticky. The question is, when will markets have fully priced in that policy path? And unfortunately, it hasn't happened yet, most notably with Jay Powell suggesting that the terminal rate might be higher. And until we get that peak pricing, I think global yields are going to remain elevated, until we can get that pivot in the, peak policy path. And the reason for that is what we're seeing here is this shows real yields, but basically it's the nominal 10-year minus the inflation rate. And what we're seeing is that in a lot of cases across the globe, inflation still remains higher than the nominal 10 years. So things are not restrictive enough, which is going to keep central banks on that tightening path. That's going to continue to invert curves. And as we know, an inverted curve is not a good sign for the growth outlook going forward. Finally, the dollar continues to push higher this year due to tightening financial conditions, the tightening Fed, and decreased global growth prospects. And what we see is that across most currencies, the dollar has been stronger, except for, let's look on the left, the blue chart, the blue lines. Those are mostly Latin American currencies, where we have seen much more policy credibility, as pointed out in the prior charts. Now, going forward, we've had a lot of elections in Latin America that are starting to bring, maybe the future policy into question, which we're going to evaluate on a case-by-case basis. But so far, despite a lot of concern, Latin American currencies have been the place to hide out. And I believe that policy credibility is going to be a key factor going forward for international markets. In the interest of time, I just wanted to point out that, yes, this has been a very brutal year for international bond markets, but if we look at where the yields are today, it gives us a tremendous starting point. And with that, Mark, let me turn it over to you.
Thank you, Bill, and good afternoon, everyone. So I would briefly like to review where we've come from since our last two webcasts. The left-hand column contains some of the bigger issues that we highlighted over the last two webcasts, this past November, a year ago November, and then this past May. The first, inflation rising Treasury yields, was a theme during both of our last webcasts and a major part of Bill's comments earlier in this call. Last November, the 10-year U.S. Treasury was at 144, having already risen from 0.91% at the beginning of 2021. Yesterday, the 10-year reached 4.21, an increase of 277 basis points year over year. The magnitude of this move had the single biggest impact on performance for EM debt, as well as many other asset classes this year. The China property sector. The situation that Sufei described over a year ago nearly a year ago, has only gotten worse. What started with Evergrande back in May of 2021 ended up engulfing the whole property sector, with over 76% of issuers trading below 50, trading at 50 cents or lower. We believe that cleaning up this sector will be very costly and take several years to resolve, adding an additional drag to China's slowing growth. We would expect to see rising non-performing loans in the banking sector, local governments scrambling to find alternative sources of funding, as land sales, which they had previously been using to fund themselves, are now likely at a standstill. EM political risk. Recent elections in Peru, Chile, Colombia, and Brazil have seen more leftist candidates come to power. Despite market concerns for potentially more radical agendas from these presidents, the balance of power between executive branch and Congress has moderated those ambitions, as well as credible institutions, judiciary, central banks, and financial markets that will keep these new administrations in check over the coming years. The pandemic. Now, this says May 2022, but this has been going on for some time. That should have probably included both time periods. We've highlighted the effects of the winding down of the pandemic across the globe during our last webcast, and this seems to be continuing due to a combination of vaccinations, herd immunity, and improved medical treatments. And as Bill mentioned, where the pandemic is still currently an issue is in China, where the effects of a zero COVID policy continue to drag on Chinese growth. The inability of the Chinese economy to get back to full production due to COVID lockdowns looks to continue into next year. We could see a spike in COVID cases globally going into year-end, going into the holidays and into year-end. However, we anticipate a milder impact, again, given to the amount of vaccinated people worldwide and those that have already had COVID. We also are hearing rumors that China may begin to lift its zero COVID policy, but not any sooner than maybe the middle of next year. The war. The Russia war had been going on for 75 days when Luce addressed this issue back in our May webcast. And here we are now, 258 days into the war with no end in sight. Bill has already discussed the impact of energy sanctions on both Russia and the West, lack of supply for certain energy and food commodities, higher prices, lower growth across the Eurozone, and other longer-term issues stemming from the conflict. And then finally, global growth slowdown. All of the above are putting pressure on global growth. One of Bill's slides indicated that the IMF in October had revised it from its developed market targets. So with these headwinds and one of our most difficult years of performance as a backdrop, I would like to walk you through the current state of our EM sovereign and corporate fundamentals. EM growth continues to be resilient despite the headwinds outlined on the prior page or prior slide. Here we can see that after the drop in growth during 2020 due to COVID and subsequent overshoot in 2021, GDP for EM has leveled out in the high 3% range and is expected to remain there through next year, despite the recent IMF revisions that reduced global growth by that 0.4% that for next year that I mentioned, as most of that that revision downward will be felt in the developed markets. This chart breaks down the expected EM GDP growth through 2023 by region. Again, flat from 2022 as a whole through 2023 is expected for now, with EM Asia, Europe, and sub-Saharan Africa ticking up in 2023, while Latin America and the Middle East show declining GDP growth over the same period. In Latin America and the Middle East, the expected slowdown in 2023 reflects slower growth, tighter financial conditions, and softening commodity prices for those regions, specifically for those regions. EM countries have done well as a whole, consolidating their fiscal balances from the COVID blowouts in 2020, returning toward the -5 to 6% range with an improving trend in 2023. Nearly all regions show improvement except LATAM, with a slight widening expected toward -4.6% for 2023. Again, with Latin America, this slight widening of fiscal balances will stem from the lower growth, lower commodity prices, higher interest rates, and social spending. Consolidated gross EM government debt as a percentage of GDP is expected to rise, again, from an expected 64% by the end of this year to 68% next year, primarily driven by Asia, and that is primarily driven by China, while the rest of Asia and other regions are expected to see flat to modest declines in their debt to GDP figures. Rising debt to GDP in China is coming primarily from financing growth through increased debt. Now we're going to move to the corporates. EM corporate net leverage for EM high grade and EM high yield ratios remain at the best levels seen in a decade at 0.9 times leverage for high grade issuers and 2.1 times for high yield issuers. Like net leverage, interest coverage levels for both high grade and high yield EM corporate issuers remain at some of the strongest levels seen in years at 14.2 times coverage for high grade issuers and 5.8 times for high yield issuers. However, with higher global rates, interest rates we have seen over the last year and expect to see additional rate movements in the coming months and the slowing global economy, we expect to see these net leverage and interest coverage ratios weaken slightly in the coming year or two, albeit from a strong base. This slide shows the relative strength of EM investment grade and high yield corporate net leverage versus EM US and European peers, with the bottom blue line representing EM and lower leverage figures. This next chart, next slide is a comparison of EM interest coverage. Also shows that both for EM investment grade and EM high yield, both ratios compare favorably with US and European peers. As I've talked about in earlier slides, EM sovereign fundamentals have not shown any dramatic changes over the last couple of years, last year or two, some weakening with some of the sovereign numbers, but stabilizing in EM corporates with strong leverage and coverage ratios. This chart, however, shows a direct impact of two of the headwinds that we have been discussing in the past webcasts, the Chinese property sector and the Russia-Ukraine war. You can see that the EM high yield solid blue line and the US high yield solid black line tend to move in tandem with each other. However, there has been a huge divergence in 2021 with a significant amount of Chinese property companies or issuers defaulting, and in 2022 with another set of Russian and Ukrainian defaults. JP Morgan expects EM high yield default rate to peak at around 11% this year, or early next year, before starting to decline. With the Chinese property and Russia-Ukraine names removed, the dashed blue line moves again roughly in tandem with high yield U.S. high yield default rates. Gross and net issuance has been the weakest in 8 years, with only $260 billion in gross issuance expected this year after a peak of $541 billion in 2021. The negative $218 billion net financing is the negative 218 net financing is the result of tender offers, buybacks, calls, and bond repayments at maturity. Much of the lower issuance had to do with market volatility versus credit fundamentals. With the 10-year U.S. Treasury yield rising 277 basis points year over year and widening EM spreads, many issuers decided to wait for lower volatility, better rates, which never came, or in the case of some weaker names, they couldn't access the market. Though the lower issuance provided a positive technical backdrop, this was offset by large outflows of nearly $83 billion through month-end October, as investors looked to reduce their EM holdings given the market volatility and weak performance. Over the past few months, we've been asked several times about market liquidity and a potential maturity wall in the EM space. With regards to liquidity, it has deteriorated throughout 2022, with the bid-ask spread wider than long-run averages, and transacting in some of the more esoteric high-yield credits has been a little more difficult. EM sovereign and high-rated corporates remain the most liquid part of our market. This slide shows that the majority of corporate debt coming due in the coming 5 to 6 years is investment grade, represented by the blue bars, with high yield maturities ranging from $77 billion to $100 billion through 2027, represented by the gray bars. EM corporates have been good about terming out their bonds early. EM issuers have either repaid or extended nearly $84 billion since the middle of the year of their outstanding debt, from $131 billion to $38 billion today, remaining for the through the end of the year. We also believe the market will ring fence refinancing issues in Russia, Ukraine, and China property credits from the rest of the corporate universe. Of the nearly $300 billion due in the remaining months of this year and into 2023, a large portion of these maturities are from investment-grade Asia and Middle East issuers, which we expect should continue to have access to the capital markets or find support from their local markets. As you can see, the headwinds mentioned at the start of my comments has led to widening of EM spreads to around 500 basis points range for the EM MB Global Diversified Index, which is sovereign quasi-sovereign index, and 400 basis point range is shown by the JP Morgan SMB Broad Diversified Index, which is predominantly made up of corporates.